An excellent approach to increase wealth is through investing, especially over an extended period of time. However, if you're new to investing, it's simple to make mistakes that could cost you money. Investment traps can be either cognitive or emotional, but they are both commonly referred to as behavioral biases. A bias is typically an unintentional tendency to act or think in a particular manner in a particular circumstance. Since investing always entails a range of possibilities and imperfect information, it is simple for investors to become imprisoned in them. Numerous elements of investment are beyond our control. Yes, we can wish for a specific result, but there is no way to ensure it. Thus, biases are only the shortcuts we employ when deciding which investments to make. So, in this video, we'll look at some of the traps you should be aware of and steer clear of. Please subscribe if you're new and give this video a like for the YouTube algorithm before we start. Let's get started now. 1. Superiority trap. Alternatively called the overconfidence trap. Many investors have inflated self-confidence and believe they are more knowledgeable than industry professionals and even the market. Even if you have a good education, you may always use a few pointers now and then. Many investors have lost a ton of money because they believed they were better than everyone else, and these are typically the same people who fall into the investment pitfalls. Investors who are stuck in the superior frame of mind have exaggerated ideas of who they are. They are overconfident in their investments and talents, and as a result, they could even ignore sound counsel that might cause them to make poor judgmental decisions. An investor could behave recklessly and take a losing position on the grounds that they believe they are more knowledgeable than the market. The investor believes that someday the market will recognize the value proposition of the company and drive it higher. However, if the stock price keeps falling, the investor decides to close the investment and cut their losses. You risk not putting in place the necessary precautions to preserve your investment capital if you have excessive confidence in the investments you're making. 2. Anchoring trap. An excessive dependence on one's initial thoughts is referred to as anchoring. It entails to some extent clinging to the notion of an asset's initial value. That leads one to make poor decisions. For instance, you might believe that a particular business is thriving and that investing in its stocks is a wise move. However, this idea might be incorrect in the near or far future. The same thing happens when an investor clings onto a stock for too long because they are clinging to a higher price than the stock was originally purchased for when the stock should have been sold long ago. One must keep an open mind, be attentive to new sources of information, and understand that just because a company is doing well now doesn't necessarily indicate they'll still be on top tomorrow if they want to avoid falling into this trap. Even when people are made aware of the bias and consciously work to prevent it, studies have shown that some factors can only partially alleviate anchoring. In any case, keep in mind that there is never a guarantee that an investment will perform well in the future. Just because a stock performed well previously doesn't guarantee that it will do so again. Investigate the asset's price history to gain a better understanding of how it has historically performed. Even if it may not quite match what you previously learned about the stock, be open to new investment information. 3. Sunk cost trap. This entails defending the choices or actions you made in the past, which are frequently detrimental to your assets. This results from refusing to acknowledge that you made the poor decision that cost you money. You may also describe it as a person's propensity to continue with an endeavor that falls short of their expectations mostly because they have already expended time or money. This explains why individuals frequently keep clothes they hardly ever wear, eat bad meals to the end, and watch movies they don't enjoy. And another reason why they continue to hang on to poor investments. Like anchoring, this strategy entails holding on to equities in the anticipation that the price would rise back to its original level. In this instance, the investor is defending their choice to purchase and hold that specific stock, which could have a detrimental impact on their portfolio. The wisest course of action would be to jump ship sooner rather than later and hunt for something more promising if your investment isn't doing well or is sinking quickly. You must accept the defeat or the reality that you made a mistake, no matter how difficult it may be. If your investment doesn't work out as you had hoped, make a change before the asset's value drops even further. A piece of advice: avoid developing any emotional attachments to your investments to make it simpler to sell them before things got worse. Setting investment goals is the greatest approach to stay out of this trap. Investors may establish performance goals for their portfolios, and if they weren't met, they could reassess them to see where they could be improved to generate higher returns. 4. Pseudo-certainty trap. The phrase, usually referred to as loss aversion, defines how an investor feels about risk. Investors limit their exposure to risk when they believe their investment returns will be positive, but when they anticipate a loss, they will extend their reach and take greater risks. They are prepared to raise the stakes to recover capital but not in order to generate more. When the possibility of losing money outweighs any chance of making money from an investment, loss aversion may be present. It typically happens when an investor is unwilling to take chances to avoid losing money. Investing always carries some risk, and some investments carry more risk than others. Loss aversion prevents you from taking advantage of opportunities to profit since you are concerned about losing your investment money. Without a question, taking on too much risk can lead to tragedy, but so can taking on too little. Create a strong financial plan and don't let feelings influence your choices. Give yourself permission to feel a bit uneasy. Make intelligent investment decisions by selecting assets with a proven track record. 5. Irrational exuberance trap. Irrational exuberance, also known as overconfidence bias, is a propensity to have an inaccurate and deceptive opinion of our knowledge and abilities. It is, in essence, the conviction that one is superior to what they truly are. Although confidence is thought to be a virtue in many situations, it is more of a drawback when it comes to investing. Investors frequently assume that the past and future are equal, acting as though there is no market unpredictability. The past will undoubtedly repeat itself. There will always be ups and downs, which will cause assets that were previously successful to lose their luster. Investor overconfidence frequently evolves to greed and pushes the market to the point where a significant correction is unavoidable. And those who bet everything right before things went bad, the overconfident ones who believe the well would never run empty, are the ones who suffer the most. If you're new to the world of investing, you might want to consider working with an expert who can develop a smart investment strategy that will maximize returns while minimizing risk. There are numerous specialists available to assist you along the route, so you don't have to rely solely on yourself. 6. FOMO. FOM, as in fear of missing out, which is strongly related to the follow-the-herd mentality since it encourages people to do what others do without giving it any thought. The propensity of a sheep is referred to as to imitate what other investors are doing. In this situation, investors, instead of using their own independent thinking to guide them, they are mostly guided by instinct and emotion. Instead of making their own well-informed selections about where they would like to invest, investors tend to copy other investors since they see them successful. When they see their friends or someone close to them heavily investing in an investment, investors who fall into this trap frequently worry that they're missing out on a potentially profitable opportunity. Following the herd makes them feel a lot better and more at peace rather than left out. For instance, many dot-com companies didn't have financially sound business plans, but many investors invested in them just because others were doing so. Investors appear to believe they are making the right choices when they follow the herd. To avoid being the only ones left behind, people feel safe exiting the market if everyone else is. Don't rush into following others' lead without first conducting your own investigation. Before selecting whether to invest, carefully evaluate the investment and examine the company's fundamentals. 7. Confirmation trap. When someone searches for and notices other investors or assets that support their present opinions, they fall into a confirmation trap. It might also happen if investors keep taking advice from people who have made the same mistakes before and are still doing so. To choose wisely this time, folks will occasionally ask these people for help. Reach out to new sources who can provide you with sound advice on potential investment opportunities rather than listening to someone who provided you lousy advice. Investors may unintentionally seek for or favor information when studying an investment that confirms their pre-existing assumptions about the asset or strategy and fail to acknowledge information that challenges those notions. Investors end up with a biased perspective as a result, which leads to bad choices. Confirmation bias contributes to investor overconfidence, explains why they don't always act rationally, and may support claims that the market operates inefficiently. Knowing that confirmation bias exists would be the first step towards conquering it. They should look for opposing viewpoints that contradict their perspective after acquiring evidence that bolsters their thoughts and opinions. Simply put, have an open mind. It's true that investing carries risk, but if you fall into one of 7 investment pitfalls, you can be even more at danger. Find out what works for you by conducting your own research in advance. By using a few of these suggestions, you can prevent wasting time and money. And with that, I sincerely appreciate your interest. Enjoy your week, and I'll see you all in the following one.